Listen, I've just done something I never thought I'd do. After 50 years of building Bridgewater Associates, from my two-bedroom New York apartment into the world's largest hedge fund, I sold my last remaining shares, all of them, $124 billion in assets under management, gone from my direct control. People ask me how I feel about walking away from the empire I built with my bare hands. And honestly, I'm thrilled. I'm thrilled because I built something that works without me, something that's alive and growing even better than when I was running it day to day. But before I step away completely, before I close this chapter of my life, I want to share with you the 5 core principles that made it all possible. These aren't just investment strategies. These aren't market tactics. These are life principles that will change how you think about money, success, truth, and reality itself. I started Bridgewater in 1975 with $300 and a dream. I was 26 years old, fired from my previous job for punching my boss in the face at a Christmas party. True story. I was broke, unemployed, and frankly pretty arrogant. But I had something more valuable than money. I had principles. Over the next 5 decades, those principles guided every decision, every investment, every crisis we faced. The dot-com crash, 9/11, the 2008 financial crisis, the European debt crisis, COVID-19. Through it all, Bridgewater not only survived but thrived. We generated more money for our clients than any hedge fund in history, more than $50 billion in profits. And you know what? It wasn't because I'm some genius. It wasn't because I have some secret formula that only billionaires know. It was because I followed these 5 principles religiously, even when they were painful, even when they went against my ego, even when everyone else thought I was crazy. Today, I want to give you these principles. The same ones that took a fired, broke 26-year-old and helped him build the largest hedge fund on earth. The same ones that can transform your relationship with money, with truth, and with life itself. But I need to warn you, these principles aren't comfortable. They'll challenge everything you believe about success, about relationships, about how the world really works. They require you to face reality head on, even when it hurts, especially when it hurts. Are you ready? Good. Let's start with the most important principle of all, the one that changed my life and built Bridgewater's legendary culture. Principle number 1. Embrace radical transparency. And I mean radical. Most people think they want the truth, but when the truth shows up at their doorstep, when it's staring them in the face, they run, they make excuses, they blame others, they protect their ego instead of protecting their future. Let me tell you a story that changed my life forever. It was 1982, 7 years after I started Bridgewater. I was convinced that the economy was heading for a depression. I was so sure that I went on TV. I wrote reports. I told anyone who would listen that we were about to see the worst economic collapse since the 1930s. I was completely, utterly, embarrassingly wrong. Instead of a depression, we entered one of the greatest bull markets in history. My predictions were so bad that I lost most of my clients. I had to let go almost all my employees. At one point, I was so broke that I had to borrow $4,000 from my dad just to pay the bills and keep Bridgewater alive. Most people in my position would have made excuses. The data was wrong. The circumstances changed. Nobody could have predicted this, but I did something different. I embraced the truth. I was wrong. Painfully, publicly, expensively wrong. And instead of running from that reality, I decided to learn from it. That moment of radical transparency with myself changed everything. I realized that my biggest weakness wasn't my lack of knowledge. It was my ego. My need to be right was making me wrong. My fear of looking stupid was making me actually stupid. So I made a decision that would define Bridgewater for the next 4 decades. I decided that truth and excellence would matter more than ego and comfort. I built a culture where being wrong isn't just okay, it's celebrated, as long as you learn from it. At Bridgewater, we created something called principlism. We record our meetings. We encourage people to challenge each other, no matter their rank or position. If you're in a meeting with me and you think I'm wrong about something, you better speak up. Not next week, not in private, right there in front of everyone. I know this sounds crazy. Most companies, most relationships, most people avoid conflict at all costs. They smile and nod and talk behind each other's backs. But here's what I learned. Avoiding truth is the most expensive thing you can do. It costs you your potential, your relationships, your money, and your life. Let me give you practical examples of how this works in investing. In 2007, when everyone was celebrating the housing boom, our radical transparency culture allowed junior analysts to challenge senior portfolio managers. A 24-year-old researcher stood up in our meeting and said, "These mortgage securities don't make mathematical sense. The underlying assumptions are impossible." In most firms, that analyst would have been told to sit down and shut up. But because we embraced radical transparency, we listened. We investigated, and we positioned Bridgewater to profit from the 2008 crisis while other firms lost billions. This principle doesn't just apply to investing, it applies to everything: your marriage, your career, your health, your finances. Most people live in what I call thoughtless bubbles. They surround themselves with people who tell them what they want to hear. They avoid feedback that might hurt their feelings. But successful people, wealthy people, people who build lasting value, they do the opposite. They seek out disagreement. They pay for criticism. They create systems that force them to face reality, even when reality is uncomfortable. Here's how you can implement radical transparency in your own life. Principle number 2. Think like a machine, not like a human. This might sound cold, even offensive, but hear me out. Humans are emotional creatures. We're wired for survival in a world that no longer exists. We panic when markets crash. We get greedy when markets soar. We make decisions based on fear, hope, anger, and ego. And those emotions, while perfectly natural, are wealth destroyers. Machines don't have emotions. Machines process information objectively. Machines follow logical sequences. Machines don't get scared when numbers go down or excited when numbers go up. And that's exactly how you need to think about money and markets if you want to build lasting wealth. Let me tell you how I learned this lesson. In the 1970s, I was trading commodities for farmers and cattle ranchers. I'd watch these guys make decisions based on gut feelings, superstitions, what their neighbor told them at the coffee shop. When corn prices went up, they'd get excited and plant more corn. When prices crashed, they'd panic and sell everything. But I started noticing patterns, economic patterns, mathematical relationships, cause and effect chains that repeated over and over throughout history. I realized that the economy isn't random. It's not unpredictable. It's a machine, a complex machine, but a machine nonetheless. Think about it this way. When you're hungry, you eat. When you're tired, you sleep. When you borrow money, you eventually have to pay it back. These aren't mysterious forces. They're predictable human behaviors that create predictable economic patterns. I spent decades studying these patterns, and I discovered what I call the economic machine. Here's how it works. Productivity growth drives long-term economic expansion. Short-term debt cycles create business cycles every 5 to 10 years. Long-term debt cycles create major economic restructuring every 50 to 100 years. Understanding this machine changed everything for me. Instead of reacting emotionally to each market movement, I started thinking systematically. When everyone was panicking in 2008, I wasn't scared, I was calculating. The machine was working exactly as it was supposed to work. Excessive debt was being deleveraged. Asset prices were correcting. It was painful, but it was predictable. That's when I created our all-weather portfolio strategy. While other funds were getting crushed because they bet on one economic environment, we built a portfolio that could handle any environment: inflation, deflation, growth, recession. We didn't try to predict what would happen. We prepared for what could happen. Here's the key insight. You don't need to be smarter than the market. You don't need to predict the future. You just need to understand the machine and position yourself accordingly. Let me give you the practical framework I use. I call it the three-level think. First, you have to understand what happened. Second, you have to understand why it happened. Third, you have to understand what will probably happen next, based on the patterns you've observed. Most people stop at level 1. They see their portfolio down 20% and they react. My stocks are crashing. I need to sell. But they never ask why. They never study the underlying mechanics. Machine-like thinking asks different questions. Why are stocks falling? Is it because interest rates are rising? Is it because earnings expectations are too high? Is it because there's too much leverage in the system? And if this is the cause, what does history tell us usually happens next? Here's a personal example. In early 2020, when COVID hit and markets crashed 35% in 5 weeks, people called me panicking. "Ray, what do I do? Should I sell everything?" I told them to think like a machine. The virus is disrupting productivity temporarily. Governments will respond with massive monetary and fiscal stimulus. This stimulus will eventually reflate asset prices. The machine is working exactly as designed. People who thought emotionally sold at the bottom and missed the entire recovery. People who thought like machines either held on or bought more. By August 2020, markets had fully recovered. The machine had worked its magic again. But here's what's crucial. Thinking like a machine doesn't mean becoming emotionless. It means channeling your emotions productively. When you feel fear, that's data. When you feel greed, that's data. When everyone around you is panicking or celebrating, that's extremely valuable data. The machine processes that data objectively. Fear is spiking, which means we're probably near a bottom. Greed is peaking, which means we're probably near a top. The crowd is doing X, which means I should consider doing Y. This is how I built my wealth over 50 years. Not by being the smartest guy in the room, but by thinking systematically, instead of emotionally. Not by predicting every market move, but by understanding the underlying machine and positioning for multiple scenarios. Now here's how you can start thinking like a machine today. First, study the patterns. Look at market history. Look at economic cycles. Look at how human behavior creates predictable outcomes over time. Second, create systematic rules for yourself. When markets fall X%, I buy more. When my portfolio allocation gets Y% out of balance, I rebalance. When everyone is talking about easy money, I get more conservative. Third, remove your ego from the equation. The machine doesn't care about your opinions. It doesn't care about your political beliefs. It doesn't care about your personal preferences. It just processes cause and effect, action and reaction, stimulus and response. And finally, practice emotional discipline. When your emotions are screaming at you to do something, pause. Ask yourself, what would the machine do here? What do the patterns suggest? What does history teach us about situations like this? This is how you build lasting wealth. Not by outsmarting the market, but by understanding how it works and working with it instead of against it. Not by fighting the machine, but by becoming part of it. That's principle number 2. Think like a machine. Process information objectively. Follow systematic rules, and let the patterns of human nature work for you, instead of against you. Now let's talk about principle number 3, which is probably the most misunderstood concept in all of investing. Principle number 3, all-weather diversification. And this is probably the most misunderstood concept in all of investing. Most people think diversification means owning a bunch of different stocks. They'll buy Apple, Microsoft, Google, Amazon, and think they're diversified. But here's the problem. When the market crashes, all those stocks crash together. That's not diversification. That's the illusion of diversification. Real diversification means owning assets that don't just look different, they behave differently. They respond to different economic forces. They thrive in different environments. So when one part of your portfolio is struggling, another part is actually performing well. Let me tell you how I discovered this. It was the 1990s, and I was managing money for some of the smartest institutional investors in the world. Pension funds, sovereign wealth funds, endowments. These weren't day traders. These were long-term investors who needed consistent returns in any market environment. But here's what I noticed. Every traditional portfolio strategy failed during certain economic periods. Growth strategies failed during recessions. Value strategies failed during growth spurts. Bond strategies failed during inflation. Stock strategies failed during deflation. There was no strategy that worked all the time. So I asked myself a simple question. What if I could build a portfolio that performed well in any economic environment? What if I could create an all-weather investment approach? I started by identifying the 4 basic economic environments: rising growth, falling growth, rising inflation. Every economic period in history falls into one of these 4 categories. The key insight was this. Different asset classes perform well in each environment. Stocks love rising growth. Bonds love falling inflation. Commodities love rising inflation. Treasury bills love falling growth. Instead of trying to predict which environment we'd be in, I decided to own pieces of all of them, weighted by risk, not by dollar amount. This was revolutionary. Most portfolios are weighted by how much money you put into each investment. If you buy $10,000 of stocks and $10,000 of bonds, you think you have a 50-50th portfolio, but you don't. Stocks are much more volatile than bonds, so they contribute about 90% of your portfolio's risk. When stocks crash, your balanced portfolio gets crushed. Risk parity changes this. Instead of equal dollar weights, you give equal risk weights to each asset class. This means your portfolio performs consistently across all market environments, not just the ones that favor stocks. Let me show you how powerful this is with real numbers. From 1996 to 2020, the traditional 60-40 stock bond portfolio returned about 8% annually. Not bad, but it had some terrible years. In 2008, it lost 23%. In 2000 to 2002, it lost money 3 years in a row. Our all-weather approach returned about 7.5% annually over the same period. Slightly lower return, but here's the key. It never had a terrible year. Its worst year was down about 4%. It made money in 2008 when everything else was crashing. It made money during the dot-com crash when growth stocks got obliterated. Which would you rather have? Slightly higher returns with massive volatility, or slightly lower returns with consistent performance? Most people choose the volatility because they focus on the best case scenario. But wealth is built by avoiding the worst case scenarios. Here's why this matters for you. Most people's financial lives are destroyed, not by market downturns, but by their emotional reactions to market downturns. They panic. They sell at the bottom. They miss the recovery. All-weather diversification removes the need to panic because your portfolio is designed to handle whatever happens. But diversification isn't just about asset classes. It's about time horizons. It's about geographic regions. It's about economic sectors. It's about everything. True diversification means that no single event, no matter how catastrophic, can destroy your financial future. Let me give you a practical framework. I call it the four-pillar approach. Pillar 1, growth assets, stocks, real estate, private equity. These do well when the economy is growing faster than expected. Pillar 2, defensive assets, high-quality bonds, treasury bills, cash. These do well when growth is slowing or falling. Pillar 3, inflation hedges, commodities, real estate, inflation-protected bonds. These do well when prices are rising faster than expected. Pillar 4, deflation hedges, long-term government bonds, treasury bills. These do well when prices are falling or growing slower than expected. The magic happens when you balance these four pillars by risk contribution, not by dollar contribution. This way, your portfolio performs well in any economic environment. But here's what most people get wrong about diversification. They think it's about reducing risk. That's not the point. The point is to improve your risk-adjusted returns. You're not trying to eliminate risk. You're trying to take smarter risks. Think about it this way. If you put all your money in lottery tickets, you have high risk and low expected returns. If you put all your money in treasury bills, you have low risk but also low returns. All-weather diversification gives you moderate risk with high expected returns. That's the sweet spot. I've been using this approach for over 25 years now, through every type of market environment you can imagine. .com crash, 9/11s, 2008 financial crisis, European debt crisis, COVID pandemic, inflation surge. Principle number 4. Principles over personalities. And this one nearly destroyed me before it saved me. Here's the brutal truth about human nature. We all think we're special. We think our instincts are better than everyone else's. We think our gut feelings are more accurate than data. We think our experience makes us immune to the same mistakes that destroy other people. I was the king of this delusion. By the 1980s, I'd built a successful track record. I was managing hundreds of millions of dollars. I was getting invited to speak at conferences. People were calling me a genius, and I started believing my own press. I thought Ray Dalio's intuition was more valuable than systematic analysis. I thought my personality, my gut, my feel for markets was what made me successful. I was dead wrong, and it almost killed my business. The wake-up call came when I realized something terrifying. My best investment decisions had nothing to do with my personality. They came from following systematic principles that I'd developed over years of studying market patterns. My worst decisions, the ones that cost me and my clients millions, came from trusting my gut instead of trusting my principles. Let me give you a specific example. In 1987, I was convinced that the stock market was overvalued. My principles, my systematic analysis told me that stocks were expensive relative to their fundamentals. But the market kept going up, day after day, week after week, and my ego started talking. Maybe you're wrong this time, Ray. Maybe this time is different. Maybe you should abandon your principles and chase the momentum. Thank God I didn't. I stuck to my principles instead of my personality. When Black Monday hit in October 1987 and the market crashed 22% in a single day, Bridgewater was positioned perfectly. We made money while other firms lost fortunes. But here's the key insight. It wasn't Ray Dalio who made that money. It was the principles, the systematic approach, the objective analysis. If I'd trusted my personality, my fear of missing out, my ego, my desire to be popular, I would have gotten crushed. That's when I realized something profound. Successful investing isn't about having a great personality. It's about building great principles and following them religiously, especially when your personality is screaming at you to do the opposite. This applies to every area of life, not just investing. Your marriage isn't successful because you're a naturally gifted spouse. It's successful when you follow principles, communication, honesty, mutual respect, even when your emotions are telling you to be defensive or angry. Your business isn't successful because you're a charismatic leader. It's successful when you follow principles, customer focus, continuous improvement, truth seeking, even when your ego wants to take shortcuts or avoid difficult feedback. Your health isn't good because you're naturally disciplined. It's good when you follow principles. Regular exercise, healthy eating, adequate sleep, even when your personality wants to binge watch Netflix and eat ice cream. At Bridgewater, I institutionalized this concept. We created what we call principlism, a systematic approach to decision-making that removes personality from the equation. Every major decision gets evaluated against our principles, not against what feels good or what makes us look smart. We even created algorithms, actual computer programs, that embody our investment principles. These algorithms don't have egos. They don't have bad days. They don't get scared or greedy or angry. They just process information according to the principles we've programmed into them. And guess what? These algorithms consistently outperform human decision-making, even the decision-making of very smart humans, because they follow principles religiously while humans follow their personalities sporadically. Here's how this works in practice. Let's say you're deciding whether to buy a stock. Your personality might say, "I love this company. I use their products. The CEO seems smart." But principles-based thinking asks different questions. What does the valuation suggest? What does the historical data show? What do the fundamentals indicate? The personality-driven investor buys stocks they like. The principles-driven investor buys stocks that meet specific criteria, regardless of personal feelings. The personality-driven investor holds on to losing investments because they can't admit they were wrong. The principles-driven investor has systematic rules for when to sell, and they follow those rules automatically. The personality-driven investor panics during market crashes and gets greedy during market bubbles. The principles-driven investor has predetermined responses to both scenarios. This doesn't mean you become a robot. It means you become a better human. Your principles are the distilled wisdom of your best thinking, your deepest analysis, your most rational moments. Following principles means you're consistently operating at your highest level instead of your most emotional level. But here's the hard part. Developing and following principles requires you to acknowledge that your personality, your instincts, your gut feelings, your natural reactions isn't reliable. This is incredibly difficult for most people to accept. We want to believe we're intuitive geniuses. We want to believe our first instincts are usually right. We want to believe our experience and wisdom make us immune to systematic errors. But the data shows the opposite. Even the smartest people make predictable, systematic mistakes when they trust their personalities over their principles. So how do you build this discipline? First, document your principles. Write down your rules for investing, for decision-making. Principle number 5, bet against the crowd. And this is the principle that will make you the most money and make you the most uncomfortable. Here's a fact that will change how you think about markets forever. The crowd is wrong at every major turning point. Not sometimes, not usually, always. When everyone is buying, it's time to sell. When everyone is selling, it's time to buy. When everyone is optimistic, be cautious. When everyone is pessimistic, be aggressive. This isn't just investment advice, it's human psychology. Crowds are driven by emotion, not logic. They follow trends instead of fundamentals. They extrapolate recent experience into the future, and they always push good things too far and bad things too far. Let me tell you about the most profitable decision I ever made, and it came from betting against the crowd when everyone thought I was insane. It was 2007. Real estate was booming. Everyone was getting rich flipping houses. Banks were giving mortgages to people with no income, no assets, no verification. Financial TV was calling it the new economy. Smart people, educated people, successful people were all saying the same thing. Real estate never goes down, but I was looking at the data differently. I was thinking like a machine, not like the crowd. The numbers didn't make sense. Home prices had disconnected from fundamentals. Income, rent, replacement costs. Debt levels were astronomical. The whole system was built on the assumption that prices would rise forever. So I did something that made me extremely unpopular. I started betting against the mortgage market, not just avoiding it, actively betting that it would crash. My team thought I was crazy. My clients questioned my judgment. Financial media criticized my pessimism. But here's what I learned over 5 decades. When something is truly obvious to everyone, it's obviously wrong. When the crowd reaches complete consensus, they've already pushed prices as far as they can go. There's no one left to buy. The only direction is down. In 2008, when the mortgage market collapsed and took the entire global financial system with it, Bridgewater made billions, while other firms lost trillions. But it wasn't because I was smarter than everyone else. It was because I was willing to bet against the crowd when the crowd was most confident. This pattern repeats throughout history. In 1999, everyone knew that internet stocks would keep rising forever. The crowd was completely convinced that this time is different. Technology had changed everything. Old valuation metrics didn't matter. Anyone who questioned this narrative was called old-fashioned. I wasn't a technology skeptic. I understood that the internet was revolutionary, but I also understood that when something is priced for perfection, it usually disappoints. When everyone expects infinite growth, any slowdown creates massive losses. The dot-com crash wiped out $5 trillion in value. Companies that were sure things lost 90% of their value or disappeared completely. But the signs were obvious if you were willing to look past the crowd's enthusiasm. Here's the psychological principle behind this. Humans are social creatures. We're hardwired to follow the group because, historically, going against the tribe meant death. But in modern markets, following the crowd means financial death. The crowd creates bubbles by chasing momentum. Everyone buys because prices are rising. Prices rise because everyone is buying. This feedback loop continues until there's no one left to buy, and then it collapses under its own weight. The crowd creates crashes by panic selling. Everyone sells because prices are falling. Prices fall because everyone is selling. This feedback loop continues until there's no one left to sell, and then it reverses. Understanding this pattern is incredibly valuable, but acting on it is incredibly difficult. Why? Because betting against the crowd means being lonely, criticized, and wrong for longer than you'd expect. It means watching other people get rich while you wait for fundamentals to matter again. Let me give you a framework for contrarian thinking. First, identify extreme consensus. When 90% of people believe the same thing, start getting suspicious, not skeptical of the underlying trend, skeptical of the crowd's expectations about that trend. Second, separate the story from the price. The internet really was revolutionary in 1999, but that didn't mean internet stocks were worth any price. Real estate really is a good long-term investment, but that doesn't mean houses are worth any price. Third, look for disconnects between fundamentals and sentiment. When prices move far from historical relationships, earnings, revenues, book values, replacement costs, start asking why. Usually it's because the crowd has convinced itself that this time is different. Fourth, be patient. Crowds can stay irrational much longer than you'd expect. Isaac Newton lost a fortune in the South Sea bubble because he bet against the crowd too early. Timing matters in contrarian investing. But here's the most important insight. You don't have to bet against the crowd actively. Sometimes, just not following the crowd is enough. When everyone is leveraging up, stay unleveraged. When everyone is taking huge risks, take moderate risks. When everyone is selling, just don't sell. In 2020, when COVID hit and markets crashed 35% in 5 weeks, the crowd was panicking. Sell everything. The world is ending. But if you understood the machine, if you knew that governments would respond with massive stimulus, you didn't need to be a contrarian genius. You just needed to not panic with everyone else. This principle applies beyond investing. When everyone is rushing into the same career, consider different paths. When everyone is moving to the same city, look at overlooked locations. When everyone is following the same strategy, think about different approaches. But remember, betting against the crowd doesn't mean being contrarian for the sake of being contrarian. It means think. Let me bring all of this together for you. These 5 principles embrace radical transparency. Think like a machine. Diversify for all weather, follow principles over personalities, and bet against the crowd. They're not just investment strategies. They're a complete philosophy for navigating life in a complex, unpredictable world. For 50 years, I've lived by these principles. They've guided me through every crisis, every opportunity, every major decision. They took me from a broke 26-year-old who got fired for punching his boss to building the largest hedge fund in human history. But more importantly, they gave me something money can't buy: peace of mind. You see, wealth isn't just about having a big number in your bank account. Real wealth is having the confidence that you can handle whatever life throws at you. It's knowing that your financial future doesn't depend on luck or timing or being smarter than everyone else. It depends on following sound principles consistently over time. Here's how these 5 principles work together. Radical transparency gives you accurate information about reality. Thinking like a machine helps you process that information objectively. All-weather diversification protects you from whatever reality brings. Following principles over personalities keeps you disciplined when emotions are high. And betting against the crowd gives you the courage to act when opportunities are greatest. This is a system. Each principle reinforces the others. Transparency without systematic thinking becomes overwhelming. Systematic thinking without diversification becomes risky. Diversification without principled discipline becomes ineffective. And none of it works if you don't have the independence to act when it matters most. I'm 76 years old now. I've seen more market cycles, more economic crises, more human drama than most people could imagine. I've worked with presidents and paupers, billionaires and beginners. And you know what I've learned? Success isn't about being exceptional. It's about doing ordinary things extraordinarily consistently. These principles are ordinary. There's nothing magical about them. There's nothing that requires genius-level intelligence or billion-dollar capital. But following them consistently, especially when they're uncomfortable, especially when the crowd is going the other way, that's where the magic happens. I want you to understand something that took me decades to learn. You don't build wealth by avoiding all mistakes. You build wealth by making fewer mistakes than everyone else, and by learning faster from the mistakes you do make. These principles don't guarantee you'll never lose money. They guarantee you'll lose less money, less often, and you'll recover faster when you do. The markets will crash again. There will be more bubbles, more panics, more once-in-a-lifetime events. Technology will disrupt entire industries. Geopolitics will create uncertainty. economic cycles will continue cycling. But if you follow these principles, if you make them part of who you are, you'll not just survive these challenges, you'll profit from them. Let me share something personal with you. When I decided to step away from Bridgewater, to sell my remaining shares and move to the next phase of my life, people asked me if I was worried. Ray, aren't you concerned about your legacy? Aren't you afraid the firm will fail without you? The answer is no, and you know why. Because Bridgewater was never about Ray Dalio. It was about principles. The same principles I've shared with you today. I built something that works without me because I built it on timeless truths, not on personality or charisma or individual brilliance. That's what I want for you. I want you to build a financial life that works without needing perfect timing, without needing to be smarter than everyone else, without needing luck. I want you to build wealth based on principles that have worked for centuries and will continue working for centuries to come. But here's my final challenge to you. Don't just listen to these principles. Live them. Write them down. Practice them. Make them part of your daily routine. When markets are crashing,